Folks, hello and welcome back to the Money Wisdom Podcast powered by Johnson Brunetti. I'm Nick Colantuono. I'm a certified financial planner here with the team up in our Boston, Massachusetts offices, as always, joined by my podcast partner, Jake Doser. Jake, welcome back, my friend. Good to see you. Why don't you introduce yourself?
Thank you, sir, as always. My name is Jake Doser. I'm a certified financial planner and certified private wealth advisor here on the team in Connecticut.
That you are, and we're glad you're with us. Viewers, listeners, we are especially glad you're all with us. We've got a great podcast today, and it's timely because November, Jake, is Long-Term Care Awareness Month.
Yes.
So let's spread the awareness. Let's make people aware of what, why, when, and how to go about getting this coverage that you need. Because as you know, it's not just about the care itself. There's a lot of different levels to long-term care. Really what it all comes down to, and you know this, of course, it's about protecting your assets that you've worked hard to accumulate. And, you know, again, legacy becomes a key part of the planning that we do here. And nobody wants to think about these later years in retirement. We always plan for the early years, the fun years. But of course, the fun eventually stops. I hate to be grim, but at that point, asset protection when it comes to covering your care is critical, isn't it? So let's unpack some of the different options. And I was actually reading a statistic, and you and I were talking about this before we started recording, but 58% of people feel that Medicare will actually cover long-term care expenses. But as you know, the care there is limited. So it's essential to have your own plan. So let's talk about what those options are. Of course, Jake, option number one, you hear about it, you read about it, the various types of long-term care insurance. Mm-hmm. So let's unpack some of those options. Why don't you kick us off?
Yeah, you know, before we even talk about like, do you buy insurance or not, it's important to know what options are available. So generally speaking, there's three options when you're thinking about long-term care insurance. Option number one is traditional, use it or lose it. A lot of times we refer to it as. And this is similar to like car insurance or homeowners insurance in that you're basically buying a piece of paper every month that says, if I have this event, I'm covered. This is the most affordable of the options from a monthly cost or premium outlay. The part that a lot of folks don't like is that the money that they've paid into it, which a lot of times is very expensive, it's gone if you don't use it for long-term care. Yeah. And so 58% of, as you mentioned, Americans think that Medicare will cover it. And in reality, Medicare really only covers like the first 100 days. And it's really more designed for like rehab long-term care usage, not nursing home or hospice long-term care usage. So it's really like, does it cover it? Yes, but not the full story. And so option one is, again, this use it or lose it option. Least expensive of the insurance purchases. But if you don't use it, it's gone. Option two is you could buy a hybrid plan. Now, a hybrid plan comes in two forms. So this is option 2 and 3. Option 2 is what they do is they take life insurance, whole life insurance, and long-term care insurance, and they combine them together. How is that accomplished? Well, effectively what you're doing is you're buying a whole life insurance policy. And then if you pass away and you never use the long-term care, the death benefit goes to your heirs or your surviving spouse. But here's the kicker where the long-term care component comes in, is that if you do use it for long-term care, the death benefit, or at least a portion of it, serves as a nursing home cost coverage or assisted living or sometimes home health care, right? So it becomes versatile in that I never don't get the value out of it effectively. A lot of times the premium you pay becomes the cash value, and then you could borrow or withdraw from the cash value. You could use the death benefit as a long-term care insurance, or you can use the death benefit as a true death benefit to your heirs. None of these are without their upsides and downsides. This one's the most versatile. Downside is that the cash value effectively doesn't really grow well. Number two, it's more expensive, because you don't walk away with nothing ever. And so that means that it's going to be more costly. Option number 3, which is sort of part 2 to this, is a hybrid plan with an annuity. Sometimes in special instances, you can take money outside of a retirement account and you could buy with a lump sum an annuity where maybe it offers a fixed rate of return. And that value is maybe worth what you put into it. So you take $100,000, you put it in, it's worth $100,000 as a death benefit. And that can, maybe it grows 2, 3, 4% a year. But then if you own a nursing home, sometimes it's doubled or tripled. So instead of only being worth $100,000 to a nursing home, it's worth $200,000 or $300,000. So again, you get this versatility of, okay, the money means something to me. It means something to my heirs. It means something even more to the nursing home. That's effectively a difference in what the chassis underdriving product is. And then you add this long-term care feature on it. Regardless of the type of product, it's important to know there are options. It's important to know how do these options fit into my larger plan. And it's important to know which one's most effective at looking to satisfy my need.
Yeah, that's great. Thank you. It can be pretty overwhelming.
Yeah.
I think when you approach the subject of long-term care, folks, keep in mind whenever insurance comes into the picture, the only time you can get it is when you don't need it.
Yeah.
So it takes proactive planning. We're having conversations with clients, particularly when it comes to long-term care insurance. We're looking at longevity. We're looking at family health history. And what we haven't really talked about is qualifying for all these different types of coverage, because whenever you have a long-term care component, or if it's wrapped inside of a life insurance policy, you're going to have to go through some medical underwriting. You're going to have to open the door to, exams and, medical history and blood tests and all these things. And, if you're at a point in life where maybe your health is already starting to go downhill, well, what is already an expensive proposition might be that much more expensive.
Right.
So again, if an insurance company sees the writing on the wall as far as like insurable need goes, keep in mind, folks, these can be pretty expensive policies to get. Not only that, they can be hard to qualify for.
Yeah.
So underwriting is certainly something that you need to be aware of. Now, when it comes to being quote benefit eligible, because again, you could get underwritten, you could get approved, you could be paying for one of these policies, but to the viewer's question here, how do you then get money out? It's all about your ability, or rather inability, to perform 2 of 6 activities of daily living. So the definition that people typically think of is what's called a chronic illness. So when we think of the activities of daily living, things like eating, bathing, dressing, feeding yourself, toileting, bathing, those sorts of things, if there was ever a scenario where you were deemed unable to perform 2 of those at a single time, that's when one of these long-term care vehicles would start spitting out money.
Right.
And on top of that, there are different levels of care. You think of where most people would prefer to get care and where the most affordable place to get care is. Well, that's in the home. Right? I mean, the ability to have a nurse come in and cook and clean and administer medications and, maybe bathe you, right, a couple times a week. That is obviously going to be less costly than if you are confined to some sort of a, live-in healthcare situation, whether you're in a nursing home or maybe an assisted living facility where there's around-the-clock care for you if you need it.
Right.
So again, like we said at the onset, there are rather levels to this game. So all we're saying, folks, is you need to have a plan. You need to be talking with your advisor about which of these options, if any, are worth you pursuing. Because like I said, it's hard to qualify for. It can be expensive to get. And Jake, as you mentioned, if you pass away having a good dream and you never lose the money or use the money, a lot of people don't like the idea that those dollars that were invested into that vehicle can just be gone. So that's where these hybrid products, have served a nice, medium between the traditional long-term care and just self-insuring. So now when we get off of the idea of insurance, there are rather legal actions that can be taken to protect assets in the event of long-term care, aren't there?
There are. The most common thing that folks ask us about, and just to be clear, we're certainly not estate planning attorneys, so we cannot draft these things nor give specific legal advice. Although we work so adjacent to this industry, we talk about them in context of a larger plan often. But right. The most common thing that we see attorneys drafting for folks in an effort to protect assets from a nursing home, these are not solutions solutions to be able to afford the nursing home. These are protecting assets against being taken by a nursing home. It's an important distinction, but both are important within your planning world, is irrevocable trusts. So irrevocable trust, there's two types of trusts in this world. Revocable trusts, they can be changed, sometimes called a living trust, or an irrevocable trust, as the name suggests. It can't be changed. It's not revocable. It's irrevocable. And so in this world, what happens is, person A is the grantor. They're the person putting money into the trust. And the goal here is that this irrevocable trust is a separate legal entity from you. And therefore, that money cannot be taken from the irrevocable trust to pay for your care if you need it later. Well, there's a couple things to be aware of that. Number one, with an irrevocable trust, when you put money into it, it is considered a gift. And so what do we know about Medicare or Medicaid specifically? That 5-year look back, right? What that means is if you go and apply for Medicaid after you've given a gift, up to 5 years or less after that, that money can be clawed back, whether it be gifted to a child, a grandchild, a friend, family, or an irrevocable trust. And so this is something that has to be done well in advance. Does this provide long-term care insurance, or does this provide being paid for the long-term care? No, it puts money outside of your arm's length so that it can't be taken for long-term care.
Sure.
And in this world, what you're doing is you're saying, I'm either deciding to, maybe I have insurance outside of this, and this is money that I want to protect above and beyond my insurance. Maybe it's I have enough money I want to self-insure, and this is money I want to put into an irrevocable trust for nursing home protection. And there's certainly other things that these trusts do. Just on this subject, we're talking about irrevocable trust. Or most often what we see is I'm funding an irrevocable trust knowing that there's not enough money outside of the trust to pay for my care out of pocket. And so I'm almost intentionally drawing my assets to a lower spot so I can qualify for Medicaid sooner, where Medicaid will cover the cost of my care.
Mm-hmm.
Although, of course, likely not at the facility that you would choose.
Sure.
So again, there's a benefit from an asset protection perspective, but there's a downside with it. You're intentionally removing money that's accessible to you. And furthermore, it's important to know that there are some tax downsides with an irrevocable trust. So most commonly we see folks put a house into an irrevocable trust and they say, oh, well, the kids will get it when I pass away. Except you might not realize that the cost basis, the purchase price amount or principal, that gets a step up to the value at your date of death if you give it to them through your passing. Whereas if you put it into a trust, that doesn't happen. So your heirs would pay taxes on the gains from the date you put it into the trust to the time they received it in most instances. So none of these, there's no such thing as a free lunch. And so keep in mind is that the use of these does protect money if done right, but does not necessarily stop other problems from manifesting.
Yeah, that's a good point. And also, whenever money goes into an irrevocable trust, like you said, I mean, that's a gift.
Yeah.
You can't just take it back.
No,
you give up control, you give up flexibility. So these, it just goes without saying, these are huge, huge considerations that need to be made.
That's right.
This is probably a good time, Jake. I want to offer all of our viewers, all of our listeners, you folks out there, I want to offer you a resource that we have. It's this book right over here if you're viewing over my shoulder. This is our Money Map book. It's really going to shine some light on our philosophy as a firm. It's going to talk about all these different strategies, the conversations, Jake, that you and I are having with clients and with prospects, with folks who are interested in this phase of life that you all find yourself in. So we want everybody watching, we want everybody listening to get their copy of this Money Map book. I almost view it as a bit of a beach read. There's not 55 chapters and 400 pages to this. We wanted it to be simple and understandable because these are some critical decisions that you're all going to be faced with. So in order to get this book, text us. Text the word MAP, M-A-P. Text it to our team at 800-757-0436. We'll get this book right out to you in the mail. Again, it's our Money Map book. We want everybody watching to get their hands on it. That's why you're here. You want some great information? This book is packed full of it. So again, text MAP, text it to 800-757-0436. So we talked about the insurance, Jake. We talked about some of the legal elements as far as the trust planning goes. Let's just talk about gifting, because I know when we talked about the irrevocable trust, like I said, you're making a gift. You're removing that money from your estate. It's now subject to those 5-year look-back periods. And you've been having these conversations long enough. People always come in and they use that phrase, oh, I don't want the nursing home to take my money. Folks, a nursing home is not going to take your money. Having said that, if you are in a nursing home and you are receiving care from that nursing home, the expectation is that if you have assets, you're going to be on the hook to pay for that care. So
Right.
we hear this saying, I don't want the nursing home to take my money. What are people really getting at?
What they mean is that, hey, I think that it's an indication that they might not necessarily get how the process to go on Medicaid works. So the way it typically works is that if I go in a nursing home, it's not like the nursing home instantly says, write me a check for all your money, please. No, a lot of times you're spending down your assets to a certain level. And so different states have a different way to do this, but generally speaking, you might start at $1 million and then you slowly chisel that money away as it pays for your care. In some instances, that might result in folks never really writing a lump sum to the nursing home, but rather paying them on a monthly basis. In other instances, the cost of their care may supersede their asset level. So at some point, you hit a threshold where it's like, oh, okay, now the state has dictated this is your minimum threshold, and that's different whether you're single or married, dramatically different. And so once you hit that threshold, then they decide Medicaid can kick in and pay for your care. So one of the final thing you could do is just like you could gift to an irrevocable trust, you could gift to your family, and so that could look like gifting to a child, a grandchild. If you're concerned about gift taxes, which are a totally different podcast for another day, you can be gifting things through to a hospital or a school bill directly, and then gift tax thresholds don't apply, right? So it's basically, what are your options? Buy insurance, decide to pay for it yourself, intentionally decide not to pay for it and go on Medicaid, which is a risk in of itself, or give your money away to a trust or a person. Those are your options when you're thinking about protecting your assets from a nursing home. Everyone gets the care they need. Not everyone gets the level of care they want based on whether they pay for it or if the government pays for it through Medicaid. So just know your options and know how it fits into your larger plan.
Absolutely. That is sage advice. We appreciate you, Jake. All right. Now here we are. We've arrived yet again, folks, to our what I believe is becoming a famous segment, the Mailbag Minute. So
Famous with our
we're
wives.
tapping into our mailbag. Like we said, November is Long-Term Care Awareness Month. We've been flooded with questions, viewers, listeners, so thank you. Keep them coming. We appreciate it because it's just going to give us more stuff to talk about in these Mailbag Minutes. You never know. We might have to do a Mailbag 2 minutes next time if we keep getting all these questions. So we have a lot of questions here, Jake, that are specific to long-term care. So Again, you only have a minute, so let's get into it. So we have a great question. My husband and I will retire with pensions and a considerable amount invested through deferred compensation and regular savings. Should we still get a long-term care plan upon retirement?
In short, you need to decide, is long-term care insurance important to me enough to the point where I'm okay setting aside assets to pay for it, assuming you can afford it? Or you need to decide, am I willing to take that risk so that I don't have to pay the premium for long-term care, knowing that if something goes sideways, I can be on the hook for all of this money. So there's never a place where you graduate beyond the need of the conversation to have insurance.
Yeah, well said. You have to assess leverage, insurability, longevity, other assets. Next, another fantastic question. When is a good idea to consider a long-term care policy? Should you do it when you're 30? Should you do it when you're 80? What do you think?
I think generally speaking, the sooner the better from a insurability perspective. But at the same time, is statistically there a high likelihood that you have a long-term care event when you're 20 or 30? Probably not. We find that the sweet spot, and certainly this is not an all size, one size fits all answer, but typically the sweet spot is like 45 to 60, probably most often 50 to 60. A lot of times before you're 50, you have so many other expenses with a mortgage and kids, et cetera, that you might not be thinking about it. And then after you're 60, insurability is a huge concern. So the sooner the better to an extent.
All right, last question here, Jake. It's about healthcare and tax filing. If my husband starts Medicare at 67, I'll be 62, self-employed, and will need to get my own health insurance. I currently have an HSA, and we always contribute the max, and we file jointly. Would it make sense to file separately?
Probably not. Probably not. In rare instances, does it make sense to be married filing separately? Student loan debt is one of the few exceptions to that. What you're basically saying is, do we want the benefit to being separate so that one of us can get cheaper health insurance from Medicare and the other one can get cheaper health insurance through Access Health CT or the Mass Health Connector if you're in Mass? Generally speaking, it's probably not going to save you money to do that.
Yep, you're exactly right. So thank you. Folks, again, before we sign off here, we want everyone watching, everyone listening to get their copy of the Money Map book. This book right here, it's going to shine some light on our philosophy as a firm. It's really going to talk about some of the strategies we're using. And we want everybody watching to get it. These are critical decisions, critical discussions that you need to be having with whoever you're going to get advice when you need it. So again, text the word MAP, M-A-P. Text it to us, 800-757-0436. Our team will get that Money Map book right out to you ASAP. Again, it's MAP, M-A-P, 800-757-0436. And Jake, my friend, you have done it again. This has been one more just yet amazing podcast in your catalog of podcasts. And I appreciate the advice and guidance.
Nick, you must want something from me. It's too nice.
I'll message you offline, my friend. I have a big ask. Anyway, November, folks, it's Long-Term Care Awareness Month. Make sure that you have a plan in place to address all the what ifs that get thrown your way. Jake, I'm sure you have just as many stories, unfortunate ones, as I do when it comes to folks who are maybe a little too late to the game when it comes to planning for these what ifs. And then, we see what can happen when you aren't prepared and you don't have a plan in place. So folks, have these conversations with your advisors, have these conversations with your loved ones, your spouse, your kids. Make sure everyone's on the same page when it comes to this stuff, because again, things can progress pretty quickly when you get to that point in life where, you're thinking about all this. So we are here to help. We appreciate it. And we will see you next time on the Money Wisdom Podcast.
Johnson Brunetti is a marketing name for the businesses of JB Capital and JN Financial. Investment advisory services offered through JB Capital LLC. Insurance products offered through JN Financial LLC.